Hello and welcome to Tax Takes. My name is Gay Proberts-Camp. In this video, I'll look at the international tax regimes within the income tax legislation, including the rules that apply to the foreign income of an Australian resident taxpayer and the rules that apply to the Australian sourced income of a non-resident taxpayer. As you watch this video, I recommend that you have your candidate study guide and quick reference guides open so that you can highlight and flag your learning materials. An Australian resident taxpayer is taxable in Australia on their worldwide income under Section 6(5). Therefore, to minimise the double taxation of foreign income, Australia's international tax rules contain a number of exemptions. You need to know when and how each of these exemption regimes apply. The main exemptions include foreign branch income and capital gains on active assets under Section 23AH, foreign equity distributions, or in other words, foreign dividends, where the taxpayer is an Australian company with a participation interest of at least 10% under Section 768-5, and foreign capital gains on foreign shares, where the taxpayer is an Australian company with a direct voting interest of at least 10% under Section 768-505. An important point to note is that Section 23AH applies to income from offshore investment by an Australian company via a foreign branch structure, while Sections 768(5) and 768(505) apply to offshore investment by an Australian company using a foreign company structure. Broadly, these two provisions work together to give a similar outcome to that of a foreign branch. Where foreign income does not qualify for an exemption, it is included in the taxpayer's assessable income. To minimise double taxation in this situation, Australia's international tax rules allow the taxpayer to claim a foreign income tax offset, or FITO, F-I-T-O, under Section 770-10 for foreign income taxes paid. The amount of the FITO is limited to the greater of the amount of foreign income tax that has actually been paid on the assessable income, and a $1,000 cap or a calculated amount. Broadly, what this limit does is allow a FITO up to an amount equal to the actual Australian tax payable on the foreign income. International tax rules can also impact the deductibility of expenditure for resident taxpayers. A taxpayer is not entitled to a deduction under Section 8(1) for expenditure incurred in deriving non-assessable, non-exempt, NENI, or exempt income. However, Section 25-90 allows a specific deduction for debt deductions incurred in relation to NENI income under Section 768(5), the foreign equity participation exemption, and under 23AI, the previously attributed CFC income exemption. Where a taxpayer has either inward or outward investment, the thin capitalisation rules can apply to limit the amount of debt deductions the taxpayer is entitled to claim. The thin capitalisation rules are only applicable when debt deductions, for example interest, equal or exceed $2 million under Section 820-35 and where there is excess debt. That is, the taxpayer's adjusted average debt exceeds its maximum allowable debt. The most common method of determining maximum allowable debt is under the safe harbour amount. Broadly, this method allows the taxpayer to have a debt to equity ratio of 1.5 to 1. That is, for every $1.50 of debt the taxpayer has in Australia, it must have $1 of equity. The thin capitalisation rules for outward and inward non-ADI investors are covered in detail in your learning materials. The rules applicable to ADIs are outside the scope of the taxation module. International tax rules can also attribute income to an Australian taxpayer before it has actually been received by the taxpayer. The Controlled Foreign Company (CFC) rules apply where a resident taxpayer controls a foreign company, the foreign company fails the active income test, and has attributable income. Where income is attributed to an Australian taxpayer, that income is included in the taxpayer's assessable income under Section 456. Even though it's not actually been distributed by the foreign company. When it is later distributed by the foreign company, it will be non-assessable, non-exempt income under Section 23AI. There are also international tax rules that can affect the pricing of international transactions, generally between related parties, or in other words, parties that are not dealing with each other at arm's length. Under the transfer pricing rules in subdivision 815-B and 815-C, where there is a tax benefit, the taxpayer may be required to increase their assessable income, decrease tax losses or offsets, or increase their liability for withholding tax. And the most significant international tax rules that exist are the double taxation agreements that are negotiated between Australia and other foreign countries. These agreements allocate taxing rights between the jurisdictions and therefore contain what can be described as tiebreaker rules to minimise or mitigate double taxation. There are two international tax regimes that apply to non-residents covered in your learning materials. The first regime is the Conduit Foreign Income, or CFI rules, in Division 802. These rules ensure that foreign income ultimately derived by foreign residents, but which is channeled through an Australian company, is not subject to Australian tax. CFI income is non-assessable, non-exempt income and not subject to withholding tax under Section 802-15, subsection 1. The second regime applicable to non-residents is the dividend, interest and royalty withholding tax rules in Section 128, capital B. Under these rules, the payer is required to withhold a prescribed amount of tax before a payment is made to a non-resident taxpayer or offshore branch of an Australian resident company. The income is then treated as non-assessable, non-exempt income of the recipient under Section 128D. Some important points to note in respect of the withholding tax rules are, under Section 26-25, the payer is not entitled to a deduction for any interest or royalty payment until the withholding tax has actually been paid. And the rate of withholding tax on particular types of income may be altered under a double taxation agreement. For example, under the Australia-UK double taxation agreement, the rate of withholding tax on dividends is generally reduced to 15%. There is also another withholding regime that applies mainly to non-residents, but it is not technically limited to non-residents. Under this withholding regime, certain taxable Australian property or TAP sales are subject to a non-final withholding tax at 10% of the first element of the purchaser's cost base for CGT purposes. This regime was considered earlier in your learning materials under capital gains tax. So good luck with your studies, and I look forward to chatting with you again soon.